I'm Ron DeLegge with ETF Guide. Great to see you again. Coming up on today's program, we discuss how to build a more resilient, safer investment portfolio. The idea here is to help you navigate bumpy markets. Also coming up, those of us that flunked inflation school, we're going to give you a one-on-one on what causes it and also how to protect yourself. So let's get right to it, beginning with a few important charts and updates about financial markets in 2025. This is our big picture view of major asset classes since the beginning of 2025. And our performance update chart shows that the leading performer is commodities. Yes, commodities have been lifted higher, really by precious metals, silver and gold, having stellar years. And commodities as a group, ticker symbol STCI, is a great, what we would call foundational, broadly diversified core commodities ETF. Those of us missing commodities exposure in your portfolio, I'm helping you out here. STCI is an easy way to plug that hole. And you can see here, it is the leading performer, up almost 20% since the start of the year, and easily outperforming other major asset classes from stocks, U.S. stocks to bonds, as well as global real estate. And look at Bitcoin. Bitcoin has been all over the place. You see that blue chart, that blue line on our graph here. Bitcoin now down modestly about 2.5%, and it's been all over the place. It was up as high as 34% on the year, and now it's down. And again, Bitcoin, this just shows you that it's still in the process of maturing as an asset, and it is not an established asset just yet. It's in the process of that. It's still emerging. It's still in its teenage years. And so this is quite typical, volatile performance all over the place. And in terms of where Bitcoin fits into an overall investment portfolio, as far as the architecture and the way I teach it, there's three buckets of a portfolio. You got your safety bucket, your core, and your non-core. So non-core is where but Bitcoin, if you do decide to own it, along with other cryptocurrencies, that's where it would go. It complements the core portfolio, which is always broadly diversified, exposure to the major asset classes, stocks, bonds, commodities, real estate, of course, cash. Those are the core asset classes. And you're using ETFs that are proxies of those asset classes. They're not trying to beat those asset classes or outperform. They're proxies. And so that's your core. Your non-core is everything else. That could be the more specialized strategies, the emerging asset classes like cryptocurrencies. You can even include traditional currencies and currency trading strategies, long-short funds, hedge funds, venture capital, private equity, individual stocks, active management. All of that goes into your non-core bucket. So that's just the context. We're going to talk a little bit about safety in a second. Let's look at the industry sector performance for S&P 500. And thus far this year, we've got all 11 industry groups in positive territory. And this is a very positive thing. This is healthy. That's what you want to see in a market that's got upside momentum. You want to see all industry groups participating. Now, of course, they're not all participating at the same velocity, right? But we do have about half of those industry groups in double digits, which again is a testament to the strength of this particular run. Technology, utilities, and communication services lead the way. And then the laggards, we've got real estate as well as consumer staples and consumer discretionary. All those sectors are still up but lagging. Now, in terms of industry sectors, we talked about technology leading the way. This is another picture and viewpoint of technology through the lens of 3X levered ETFs. These are funds from Direction. Now, these two focus on semiconductor stocks and the technology sector as a whole. And TECL and Soxal have been great performers this year. Now, again, recently we saw a little bit of a sell-off, kind of scary. And now we've seen a little bit of a bounce back. And we'll see. We've got the Fed coming up with their decision on interest rates December 10th and 11th. That's when the Fed meets. And so put that on your calendar. We could see a pop, possibly higher for markets if they like what they hear from the Fed. So keep your eye on these sectors that are already delivering bullish momentum. We could see them push even higher. Now, in terms of other groups, we're going to talk a little bit about inflation. This particular group, gold miners, as well as physical precious metals, physical gold and silver, have been great performers. This is an interesting chart because we're looking here at Nugget, which is the gold miner ETF 2X daily bullish performance. And we see this ETF ahead by over 100 and what is that? 183%. And so it's been a great performer. And then we've also got Dust, which aims for the opposite. That's the bear 2X. And we see that particular ETF has been pummeled. And that's usually what happens to ETFs that are leveraged when the momentum is going in the opposite direction. So again, that's Ron's rule. If you're going to use leverage ETFs, make sure that you're using the funds that are trading in the same or moving in the same direction as the momentum is in the market that you're trading in. You definitely don't want to use leverage ETFs in neutral markets or markets that are trending opposite of your trade. And then GLDM, which tracks physical gold, and GDX, which is gold miners unleveraged. You can see both of these have been great performers. And so, again, that's just the context of gold miners and gold itself. And then, of course, the leveraged picture. Of course, the leverage trade has been fantastic for bulls. Now, what's been causing, why has gold done so well? Why have commodities done so well? Well, a lot of that is due to something called inflation. And since it seems like a lot of the politicos in D.C. these days flunked inflation school, so I think we should answer a couple of questions. What causes inflation? Who causes it? And who's at fault? Let's defer to the great Milton Friedman and find out the answer.
But it comes down to the same thing. Inflation is made in Washington because only Washington can create money. And any other attribution to other groups of inflation is wrong. Consumers don't produce it. Producers don't produce it. The trade unions don't produce it. Foreign sheiks don't produce it. Oil imports don't produce it. What produces it is too much government spending and too much government creation of money and nothing else. Yes, sir.
So you'll notice that he didn't say that he didn't hyper-politicize it by saying one party is more at fault than the other party for inflation. He said the government is responsible for inflation and the primary culprit for inflation. And that's exactly what we see right now, right? We see inflation all over the place, runaway government spending, and deficit spending. And what about tariffs? You know, there's been a lot of talk about tariffs being able to cover the budget deficit. This is a look at the real bottom line numbers, the math. And the math does not show that that argument supports what has been said about tariffs. Tariffs would need to be about 9x of what they are right now in order to cover the approximate $1.9 trillion budget deficit. For full year 2025, tariffs are going to bring in about $195 billion, which again is a far cry from that $1.9 trillion hole burning the federal government's wallet, and by default, taxpayers' wallets. And so, again, a lot of the behavior that we're seeing by government, tariffs themselves are inflationary. Consumers pay it. Those are the facts. And again, it's important that we all understand this, especially those of us that flunked inflation school. Milton Friedman explains it very nice. Now, we also need to have more safety inside of our investment portfolio because safety is a core component. It's one of those cornerstones that most investors, including you, are probably missing from your investment portfolio, or you're not doing it right. You're not doing it right because you're using the wrong types of assets for safety. You're using things that can lose value, potentially, things like Bitcoin, things like U.S. Treasuries, things like even physical gold or precious metals. These are assets that are subject to fluctuations. They do not guarantee or protect your principal. And so your safety bucket should absolutely be using the right types of investments. So this is one of the cornerstones of a solid an architecturally sound investment portfolio. Safety, it's an area that most investors don't get right. They think they know how to do it, but they're not doing it correctly. And the great Stanley Druckenmiller explained it this way. He said that the way to build superior long-term returns is through preservation of capital and hitting home runs. And so we all want to hit home runs. Well, when you're not hitting home runs, when you're hitting singles, doubles, and triples and an occasional home run, that's good. But preservation of capital, protecting your capital, that's your safety bucket. And your safety bucket is so key. It's so key. I sometimes refer to it as your margin of safety. This applies to the entire portfolio, not just to how an investor picks individual securities with an intrinsic value below what the market value of the asset is. That's the traditional view of margin of safety. In the context of selecting securities, we're talking about margin of safety as applied to the entire portfolio, right? With the purpose of protecting principal, minimizing volatility, and maintaining liquidity. Margin of safety in this context is not market timing. It is different from your emergency fund. They're not the same. And it's also a permanent cushion. It's not temporary. Just like the insurance on your automobile or on your home, that's permanent, right? That's not impacted by the weather outside. You don't say, well, the weather outside is beautiful today. It's sunny, so I think I'll go without insurance today. You don't do that. Or you don't say, you know what? The weather's going to get bad in a couple of days. I think I need to maximize my insurance or increase the coverage. You don't do it that way. So it's the same way with your portfolio's safety cushion or safety net, margin of safety. It's all the same thing. I built an online course while everyone was Black Friday shopping and eating turkey and watching NFL football. I was busy rolling out a safety course, a guide for investors. And guess what? There's no Black Friday pricing because all these courses are free. This is the third course. As I was quietly at work. We've got 3 courses: Habits of the Investing Greats, Retire Securely, which deals with retirement planning issues that those of you that are nearing retirement or close to it, you need to be enrolled in that course. And then Safety, this is for all investors, experienced, inexperienced, everyone in between. A guide for investors. This is one of the essential elements of a well-built and architecturally sound investment portfolio. The links are below in the description section, so be sure to check that out. Enroll today. All right, we're going to round out today's episode with our look at the Bloomberg Billionaires Index. These are the top 10, the big money. And where is the big money? How did it get so big? Well, you look here, and 8 out of the 10 wealthiest folks on the planet have their wealth concentrated in the technology sector. And by the way, that's where they made their wealth from. And so what does that mean for us as investors? Well, that's how you should be orientating the investment portfolio. It should be oriented towards technology because that's what's creating wealth. And that's what will continue to be the case. Now, that wealth is going to fluctuate, right? We're going to have booms and we're going to have busts. That's a given. That's part of the game, right? But what we're looking at here is not a 1-inning game or 2-inning game. We're looking at a 9-inning game, a full cycle, and this will continue to be the trend. Technology, AI, blockchain, cryptocurrencies, digitalization, tokenization, all that stuff, cloud computing, as well as cyber defense, all these things are part of the technology sector. And there's other things, of course, semiconductors. There's so many aspects to this that are involved in technology. So you should have some exposure to that. Electrification, there's another one. So these are the things that are creating wealth. And again, position your portfolio, your non-core portfolio, that's a great place for some of these types of investments and assets. In terms of ETF Guide TV, just a quick reminder that you can watch our episodes, all of our original series programs, including First Look ETF with the New York Stock Exchange, ETF Battles, Metals in Motion, Spotlight, all of that, not just here on YouTube, but also on Roku, Amazon Fire, as well as Apple TV, and of course, all of those podcast streaming platforms. So, how did you enjoy today's episode? Hit me up in the description section below. Did you enjoy our little course, our little 101 on inflation, courtesy of Milton Friedman. I hope you did. And what about safety? Does your investment portfolio have an adequate cushion? Well, those of us, especially at retirement, in retirement, or nearing retirement, this is especially crucial. The more you have, the more you need to protect. So hit that description section below. Thanks for tuning in. Don't forget to hit the subscribe button. For those of you that are new to ETF Guide TV, join our community. I'm Ron DeLegge. Thanks for watching. We'll see you on the next episode.